Hi, my name is George Dagnino. I'm the editor of the Peter Dac Portfolio since 1977. You can find this publication in my blog, peterdac.com. You can also follow me at George Dagnino on tweet. I send my tweets almost every day, so you can keep track of how I think and what I see ahead for the markets. The purpose of the next two slides is to show you the importance of the business cycle on the stock market, on asset classes, and on an investment strategy. The business cycle shows the pattern of growth of the economy around its growth potential. That is, in other words, its long-term growth rate. So you see sometimes when right now the growth potential is around 2.5%. When the economy grows faster than this growth potential, you begin to see interest rates, inflation, commodities rising. This is what is typical what happens in phase two of the business cycle. At some point, though, these forces cause the economy to slow down. Growth peaks and starts coming down. What happens here? As the economy slows down, you're beginning to see the first thing that peak are commodities, eventually interest rates. The stock market in phase three becomes very volatile because earning growth declines. At this point, the economy now grows below potential, is very slow. People talk about possible recession, inflation, interest rates decline, commodities decline, the stock market is weak. At some point, low interest rates and low commodities stimulate the economy again, and the economy stops deteriorating, starts regaining strength. Interest rates in this phase and inflation are fairly stable. Commodities are beginning to start rising a little bit. And as the economy gains strength, the stock market here bottoms and starts rising. And eventually there are self-reinforcing forces, low inflation, so low interest rates, people borrow, more demand, and more sales, and there is reinforcing strength in the business cycle until the economy then goes in phase two and things start all over again with inflation, interest rates, and commodities rising. How does the business cycle work or looks like in real life? Well, this is the pattern from 2006, 2007 to December 2018. And what this curve is showing is the strength of the industrial sectors, industrial stocks relative to the overall market. And as you can see, periods that this line is rising are periods with strong economy. Periods when the industrial stocks are weaker than the market, the economy slows down, like 2007, 2009, there was actually a recession. Then the economy slowed down again between 2011 and 2012. It slowed down again 2014, 15. And guess what? It started slowing down again beginning in 2018 as industrial stocks started underperforming the overall market. What happens when this curve rises, that is, the economy is strong? You see industrial stocks, of course, being very strong, cyclical stocks, technology, stocks, sectors that depend on the economy, housing, they're all very strong. However, when the economy starts slowing down, you see more conservative stocks, staples, utilities, and bonds beginning to outperform. So right now we are in this period here when the economy is slowing down, industrial stocks underperforming. So how long will this process continue? Well, the interesting thing is that every downturn lasted at least 2 years. So this started in 2018. So the slowdown would last at least until the end of 2019, or roughly. So we could expect that an investment strategy based on a defensive sectors is probably would be more appropriate in the current economic slowdown. I hope you found this discussions useful. If not, just send me an email and let me know.